Welcome to the Stock Market Palantir. Today we are going to talk about CRWV, CoreWeave Inc., the AI hyperscaler that has really defined volatility in the market since its public debut back in March 2025. This stock is, well, it's not for the faint of heart. It swung wildly between its low 30s and nearly $190. The movement itself tells us this is a battleground where the purest optimism about the AI supercycle meets the harshest financial realities of massive capital expenditure.
Indeed. And I think this isn't just a stock, it's the definitive tug-of-war at the edge of the AI frontier. The central question we have to get to is critical. Does CoreWeave's essential strategic positioning, its role as the indispensable plumbing for high-end GPU compute, does that fundamentally outweigh the enormous, some might say existential, risks posed by its highly leveraged capital structure?
My position is and remains firmly rooted in the bullish camp. CoreWeave's aggressive valuation, its trajectory of hypergrowth, all of it is completely validated by the staggering, quantifiable demand they've locked in. And that's coupled with their unique, specialized competitive advantages. We're discussing the single purest play on the infrastructure required to power generative AI.
And I take the opposing view. The company's precarious financial structure, it's defined by a crushing debt load and a persistent inability to turn a profit even during peak demand. That introduces systemic risk. This high-leveraged model fundamentally undermines the optimistic, forward-looking valuation that the bulls are assigning to this equity. They're prioritizing market capture over solvency, and that creates an immense threat should the cycle ever slow down.
Well, let's start with the foundation of the bullish thesis, which is built on something very concrete, their revenue backlog. It's truly staggering, $55.6 billion in contracted revenue. That figure is not some hypothetical market opportunity. It is committed multi-year revenue. This gives us a tangible, immeasurable basis for modeling future cash flows, and it all but guarantees hypergrowth through at least 2028.
That $55.6 billion figure certainly looks impressive on paper, I'll give you that. But I come at it from a different way. We have to analyze the cost of securing that revenue. The aggressive inorganic growth strategy and the resulting capital structure are what concern me most. We just cannot ignore the company's debt load, which now exceeds $14 billion. This results in an astronomical debt-to-equity ratio of 361.9%.
They are financing growth.
They are financing indispensable growth through immense leverage. Let's just clarify this ratio for our listeners. A debt-to-equity ratio of 361.9% means that for every single dollar of shareholder equity, the company is carrying roughly $3.60 in debt. This leverage is necessary to finance the relentless cycle of expensive GPU purchases, the H100s, the Blackwell chips that drive the entire business model. So while you see this as prudent financing to capture a market window, I see immense refinancing risk and an immense burden of future interest payments.
But that leverage is acceptable when you pair it with their strategic entrenchment. CoreWeave is not a commodity cloud provider. It is an integrated partner. Look at their deep ties with NVIDIA, the absolute gatekeeper of GPU supply. NVIDIA not only allocates scarce chips to CoreWeave, which is a massive operational advantage in itself, but they actually invested in the company.
Right.
And the contracts with OpenAI alone represent a total relationship value exceeding $22 billion. This is, it's a symbiotic relationship, not just a vendor-client dynamic. That strategic moat is worth the leverage.
That deep relationship with NVIDIA and OpenAI is compelling. I concede it grants some critical access to supply. However, that competitive advantage in the supply chain still hasn't translated into financial stability. Let's address the core financial reality. Despite reporting a massive 133.7% year-over-year revenue increase in Q3 2025, which completely confirms the hypergrowth narrative, the company still posted a net loss of $110 million in that same quarter.
But that net loss is shrinking as a percentage of revenue.
It is. But the existence of any net loss during the absolute peak of the AI boom, when pricing power for GPU rentals is supposedly maximized, tells us something fundamental about the operating leverage. It indicates that the immense costs, we're talking depreciation, securing power, cooling, interest payments, are outpacing even this incredible revenue acceleration. How much longer can they burn capital while claiming they're indispensable?
They burn capital because they have to prioritize market dominance through superior operational capability. And this brings us back to their specialized cloud platform, which is their true operational moat. It was engineered specifically for the brutal thermal and computational demands of continuous, high-density GPU clusters. Their unique operational lineage evolved from running massive cryptocurrency mining operations before they pivoted to AI.
I'm intrigued by that crypto lineage point. How does that old business model actually give them a measurable advantage now?
It's simple, really. High-density crypto mining requires absolute ruthlessness in optimizing power usage and managing heat dissipation. CoreWeave gained superior competency in maximizing uptime and managing high-heat compute at scale, an operational specialization that, frankly, generalist hyperscalers like Amazon or Google are struggling to match because their infrastructure is designed for diverse, often lower-intensity workloads. Their bare metal cloud platform offers lower latency and higher performance, which is mission-critical for these frontier AI labs. That efficiency gap justifies their pricing and their competitive position.
Okay, that's a strong argument for their operational competency. But this competency runs directly into the most significant financial constraint they face: infrastructure scarcity, and specifically, power. Let's look closer at the Core Scientific acquisition. The dilution risk this all-stock deal introduced was significant, a roughly $9 billion transaction that caused immense shareholder friction. Why did they pay such a premium for a crypto miner?
Because it wasn't about the Bitcoin mining rigs, it was a strategic infrastructure play.
Exactly. It confirms my point about constraint. The deal proves that scaling is constrained not just by the supply of NVIDIA chips, but by the physical limits of power infrastructure. CoreWeave felt compelled to secure massive power capacity via that acquisition. Securing those power purchase agreements, those PPAs, is often more difficult and time-consuming than securing the GPUs themselves. If they have to make such aggressive, debt-fueled, and dilutive moves purely to acquire power capacity, their scaling is fragile.
I would frame it differently. The fact that they successfully executed a strategic maneuver to eliminate the primary bottleneck, power scarcity, is a point of strength, not weakness. It shows management is proactively solving the largest operational hurdle in the industry. It ensures the $55.6 billion backlog can actually be serviced. Without that power, the backlog is worthless. With the acquisition, they've strengthened the underlying foundation.
But what if that foundation crumbles under counterparty risk? That $55.6 billion backlog guarantees nothing if the customers fail to pay. We are in a highly speculative environment. What happens if the deluge of AI startups, many of whom are their contractual counterparties, run out of venture capital funding? If they fold, CoreWeave is left holding the bag, a depreciating GPU fleet with massive fixed power costs, but no revenue stream to match.
Well, counterparty risk is a valid concern in any high-growth market, but CoreWeave's contracts are highly diversified, and crucially, they rely heavily on large, established enterprise clients and industry titans. If major customers like OpenAI or NVIDIA-backed ventures were to suddenly cease payments, the entire AI industry would be in collapse, making CoreWeave's survival sort of secondary to a systemic crisis.
That's a compelling point, but have you considered the concentration risk? If Microsoft, a major potential customer, continues to heavily invest in its own internal silicon, its Maya chips, it could gradually shift workloads away from CoreWeave over the next 2 years. Even a marginal reduction in need from just a few massive clients could significantly impact their pricing power, leaving them exposed to these immense fixed costs.
And they were addressing that. CoreWeave serves as the essential overflow valve and the rapid access point for the newest NVIDIA technology, which is always ahead of internal silicon development cycles. As AI models continually demand more power, companies will always need an external partner to meet peak demand or access that specialized infrastructure.
Let's shift our attention from fundamentals to market microstructure, which has been intensely polarizing and really defines the volatility of the stock.
Oh, it is an essential part of the story. The stock's price action is defined by violent structural shocks.
Precisely. Look at the immense 33% drop that coincided with the lockup expiration windows in late summer 2025. That was compounded by regulatory filings showing significant insider selling, including Jack Decode liquidating over 4.2 million shares. The market interprets these actions as a lack of conviction from those closest to the company.
I see why you think that, but insider selling post-IPO is not necessarily a vote of no confidence. It is often planned liquidity and diversification, especially for a company that has seen such explosive growth in its stock price. Furthermore, the market microstructure suggests significant institutional maneuvering, which is, I think, often misinterpreted by the retail crowd.
Okay, so let's unpack that institutional maneuvering. FINRA data consistently shows dark pool dominance, with the off-exchange short volume ratio hovering near 50%. This high percentage of trading occurring away from lit exchanges suggests heavy institutional contention, complex private positioning, and likely extensive hedging activity. This is indicative of a deeply contested equity.
That's an interesting point, though I would frame the dark pool dominance differently, and I think this is a crucial distinction. Heavy off-exchange trading is characteristic of institutional players, pension funds, large hedge funds, long-only funds, who are accumulating large blocks of shares. They execute these trades privately to avoid moving the price on public exchanges, which would be detrimental when you're trying to acquire millions of shares.
But if they were accumulating massive long positions, why is the off-exchange short volume ratio so high? That accumulation thesis doesn't seem to reconcile with the persistent short volume.
Because market makers are heavily active in hedging their option inventories. When a client buys a massive call option betting on CRWV to go up, the market maker has to neutralize their delta exposure, their risk related to price movement, by shorting the underlying stock until they can secure those shares. This is technical hedging activity. It is not a directional bet against the company's fundamentals. It is market mechanics at work, not necessarily bearish sentiment.
That's a very precise technical distinction, but the impact of that short volume is still borne out in volatility, regardless of the intent. And crucially, let's look at the actual risk for short sellers. The days to cover ratio, the time it would take short sellers to buy back all their borrowed shares, is extremely low, sitting between 0.82 and 0.89 days.
Right, and that figure is key. It suggests short sellers are absolutely not trapped in this stock, which completely undermines the popular retail conspiracy theories about an inevitable, catastrophic short squeeze. The market is liquid enough that if the fundamentals were to suddenly deteriorate, short sellers could cover their entire aggregate position in less than a single trading session.
That's an interesting point on the reality of a squeeze, but the very existence of that retail discourse brings us to the core issue of narrative confusion that plagues this equity, making it structurally volatile.
And on that, we have to clarify a critical piece of misinformation that caused genuine panic selling among unsophisticated investors. CRWV Inc., CRWV, the actual company stock, has not executed a reverse stock split. The panic stemmed entirely from the collapse and subsequent 1-for-5 reverse split of the leverage ETF derivative, the TRAD 2X long CRWV ETF, ticker CWVX.
And the fact that this confusion could cause panic selling just highlights the intensely bipolar sentiment that dominates this equity. On one side, you have the extreme YOLO bullishness based on abstract future growth, and on the other, you have conspiracy-driven bearishness. This sort of market psychology reinforces the stock's status as a high beta derivative of the AI ecosystem itself. It's fundamentally unsuitable for traditional fundamental value investing because the sentiment swings are just too extreme.
I think it simply reflects the fundamental dual nature of the business model, which we have to reconcile. CRWV has the heavy capital expenditure profile and fixed cost base of an industrial utility. They're essentially a digital power company, but they operate with the revenue growth trajectory of a hyper-growth tech firm. This inherent conflict is what creates the volatility.
And that conflict is precisely what amplifies the financial risk. The analogy to a utility only holds if they achieve stable cash flow, which they have not. Utilities are defined by predictable, regulated profits, and massive debt, yes, but their profits are stable. CRWV is carrying the debt of a utility without the assured stable margins.
So in summary, I maintain that CoreWeave represents a singular, pure-play infrastructure investment in AI. The strategic necessity of their service, the deep relationship with NVIDIA that guarantees chip supply, the massive operational specialization born from their crypto lineage, and most importantly, the tangible $55.6 billion backlog provide a legitimate foundation for continued hypergrowth. If management successfully integrates Core Scientific and continues to secure power, the valuation will be justified.
I'm not convinced by that line of reasoning because the $14 billion debt load is not just a risk. It is the primary existential risk. The company is in a relentless, unforgiving race against the clock. It has to successfully navigate the next 24 months of capital-intensive scaling without any significant decline in GPU rental pricing power or any substantial counterparty contract failures. CRWV remains a company where its financial viability is entirely dependent on the uninterrupted continuation of the AI spending bubble. This forces a binary outcome. They either achieve critical mass and become the dominant, indispensable utility provider, or the credit bubble underpinning the GPU finance bursts, and the equity faces immense strain from insurmountable debt servicing requirements.
Ultimately, the future valuation of CRWV depends entirely on which factor the market chooses to prioritize: the rapid revenue growth and strategic necessity that the company has locked in through its backlog, or the balance sheet solvency risks inherent in its debt-fueled expansion. The material provides robust, evidence-based arguments for both of these profoundly different potential outcomes.
We've covered the staggering demand backed by the $55.6 billion backlog, the severe concerns over the $14 billion debt load and the subsequent solvency risk, the strategic but expensive acquisition of power infrastructure via Core Scientific, and the market volatility compounded by high dark pool activity and retail sentiment.
Thank you very much for hearing us. Let us know in the comments what is your opinion and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.